What's the smartest way to build your first $100,000? There are 7 essential steps to build these 3 streams of passive income, and if you want them, you need to take action right now. Your first 100K is the hardest to build, and I'm not just quoting some random great investor out there. This is coming from a millennial investor who didn't grow up with a silver spoon. Just like most people, I had to work a 9 to 5. On top of that, live in the most expensive city in the world, New York City. My progress to my first $100,000 took 4 years. Once I crossed over that $100,000 mark, it got a lot easier to reach the next $100,000 thanks to the magic of compounding. Your job is to develop 3 streams of income that will benefit from the power of compounding. They will be capital gains, dividends, and interest. Get these 3 sources of income as soon as possible, and I can assure you this will set you up for success. So if you're ready, let's get into it. Step number 1, open up a high yield savings account. Many people oversee the most crucial first step. Before you invest, you need an emergency fund, a financial safety net to cover at least 3 to 6 months of living expenses. This fund will protect you if life throws you a curveball, like an unexpected medical bill or losing your job, so you aren't forced to be selling your investments prematurely. This is exactly what had happened to me too. I lost my job working in tech, but I had enough funds in my emergency fund to keep me afloat. And if you don't have enough cash to cover 3 to 6 months of expenses, build this up in a high yield savings account first. A high yield savings account is just like a regular savings account, but with a significantly higher interest rate than a traditional savings account. While the traditional savings account gives you a pathetic 0.1% annual returns, HYSAs offer a 4% or more. So the money that you deposit into your high yield savings account will generate more than 4% of interest, which is essentially free money just for parking your savings in the right place. If you're serious about building wealth, don't ignore the power of a simple 4% growth. To make things easier for you guys, I put together a list of some of the best and highest paying savings accounts out there. They're all FDIC insured, no fees, and no minimums to start. Some of these accounts even offer additional sign-up bonuses, so be sure to check out that list to make sure you have those options. The link is in the description. So, step number 1 is simple but yet crucial. Calculate your living expenses for 3 to 6 months. Open up a high yield savings account and deposit your emergency funds in there and start earning interest while preparing your foundation for investing. Once you've secured this, your safety net, start investing into the stock market as soon as you can, which brings me to step number 2. Open up a brokerage account. There are many investment opportunities out there in the market, but first you need to open up a brokerage account. A brokerage account allows you to buy, sell assets like stocks, ETFs, mutual funds, and even cryptocurrency. By investing into the financial markets, you're looking to compound your money through investment gains and dividends. Now, not all brokerages are created equal. Choosing the right platform can make a huge difference in your experience as an investor. When I first started investing, I used one of the older legacy brokerages out there. They were outdated applications with high fees that left me really frustrated. And that's why I recommend these platforms that are innovative, user-friendly, and continuously improving. Most importantly, you earn more and pay less. Here are my top 2 brokers that I recommend. First up is Moomoo. They are offering up to 30 free stocks just for signing up and depositing as little as $100. And the biggest benefit is that you could earn up to 8.1% APY on idle cash for the first 3 months. That's 8.1% return on money that you deposited in there without doing anything. So Moomoo might really be the best option for new investors. And the second is Robinhood. They're a super beginner-friendly app that keeps investing simple. They give up to 1 free stock just for signing up. Now, when you're choosing a brokerage, here is what you should be looking for. No fees. Why pay high commissions when there's so many platforms that lets you buy and sell absolutely for free? An easy-to-use interface. You want an app or a website that's intuitive but yet easy to use. Nobody wants unnecessary stress from a clunky app that takes just simply forever to log in. Access to research tools. Look for a platform that offers stock analysis, news, education right in the app itself. There are so many free tools that helps you stay informed about what's going on in the markets. And of course, the sign-up bonuses, because who doesn't love free stocks? Once you've selected your platform, don't wait. Fund it with a small amount or whatever you're comfortable with investing in. Whether that's $100 or $1,000. Get your foot in the door so you are motivated to take your next step seriously. Remember, the goal is to take action and get started to build that momentum. Step number 3, understand your risk tolerance and investing goals. The goal is to reach your first 100K as soon as possible. So let's quickly figure out what kind of investor you should be and how to allocate your money for this specific goal. When you're younger, you can afford to take on more risk because you have time to recover from any dips. When you're closer to retirement, you would have to focus on protecting your assets, which is what you've built over time. And this is why you should take action now. So my suggestion is if you're in your early 30s or even younger than that, allocate 100% of your investments into stocks. Stocks fluctuate in greater ranges. So of course, the higher returns comes with greater risk. But the US stock market has averaged 11% growth per year for the last 100 years. So stocks are your long-term bullish assets. In other words, they build wealth over time for you if you invest consistently. And the key is consistency so that you survive in the markets and harvest the long-term growth. Just to clarify, I also invest into cryptocurrencies as well, and I'm also actively researching short-term altcoin plays as well too. However, they are much more riskier as of right now, so I wouldn't include cryptos as an essential step that you need to take to reach your first 100K. What's your take on crypto? Please share your thoughts in the comments. I'm genuinely curious. Step number 4, start investing into ETFs. You see, even though you are investing 100% into stocks, the idea of diversification still applies. You don't need to put all your eggs in one basket. You want to diversify by investing into multiple sectors and companies. If a sector underperforms, the other can help balance things out. So start with an ETF. An ETF is a basket of investments that lets you get exposures through multiple stocks or sectors in one single purchase. This is the easiest way to diversify your portfolio without the stress of picking individual stocks. Think about this. If you want to diversify into Tesla, Apple, Walmart, you have to buy 3 different stocks and keep track of all 3 of them. You would also need to analyze the financials, read the news, study the stock charts for those 3 different companies. Or you could invest into all 3 of them and hundreds of other top companies in the US if you had just bought the S&P 500 ETF. So here are 2 solid ETFs to buy, and you should buy as consistently as you can. Your first ETF should be the S&P 500 ETF. For this, simply pick VOO. It's an ETF that tracks the top 500 companies in the US, giving you exposure to the best companies across various industries. Think of owning a small piece of Apple, Microsoft, Amazon, all of them. When Apple stock declines, there are still many other strong companies in that ETF that are still going to be holding up the overall market. So this is why the S&P 500 has been a long-term bullish asset that never fails to bounce back from major economic crises. Your second ETF should be the NASDAQ 100 ETF, which is the QQQ. As we live in a tech era driven by information technology and emerging artificial intelligence, major tech giants like Tesla, Apple, Nvidia, and Google will continue to dominate the market and drive more economic growth. Investing into the QQQ is the best way to stay invested into tech and diversify across various tech companies. Should you invest into individual stocks? If you're willing to put in the research, you can invest into individual stocks. But keep in mind, picking the right stocks requires time and a lot of effort. Here's my pro tip for you. Look for companies with strong fundamentals, such as growing revenues, solid profit margins, and manageable debt. You also want to identify the competitive advantage of the company that you are going to be investing in. What makes this company stand out from the rest of the industry? For example, what makes Tesla more valuable than all the other EV brands? Is it the future growth potential in AI? Is it all the other companies that Elon Musk owns and their consistent expansion into new markets such as robotaxis? Think about it. If you're new, a great way to learn about stocks and source investment ideas is to join the Blossom Social Investing app. It's a free social media platform for investors. You can follow me and see all the stocks that I currently own and get notified whenever I buy or sell my shares. Users are actively sharing their thoughts on all kinds of stocks every single day. So join us for free with the link below. You don't need to invest everything all at once. Start small and stay consistent. Set aside a portion of each budget every single month for investments, and over time, your portfolio will grow. So the best way to stay consistent is to automate your investments, which leads me to step number 5. Automate your investments. This prevents you from making emotional and impulsive decisions, which will help you stick to your goal of compounding until you reach your first 100K, because you're regularly putting money into the market without having to think about it. This is also called dollar cost averaging, or DCA for short, which is investing a fixed amount of money at regular intervals, no matter what the market is doing. So here's how to do it. Step number 1, set up automatic deposits into your brokerage account. Step 2, schedule recurring investments into your chosen ETF or stock weekly, bi-weekly, or monthly. Whatever interval it is, just set it. Number 3, let automation do the work while you focus on learning and refining your strategy. Automating your investments is a powerful way to build discipline and consistency, two of the most important traits of a successful investor. Now that your investing strategy is running on autopilot, let's move to tax advantage accounts and how they could help you save more money on taxes. If you're following these steps so far, please give this video a like and don't forget to ask any questions that you may have in the description down below. Step number 6, maximize tax advantage accounts. You need to take advantage of tax advantage accounts. When I didn't know much about capital gains taxes, I was happy with my profits that I made in the stock market until I got hit with an unexpected bill from the IRS. There are simple things that you could do right now to grow your investments while saving on taxes, which will make a huge difference over time. Trust me. If you have a job, contribute to your 401k. Many employers also offer a matching contribution, which is essentially free money. If your employer offers a match, make sure you're contributing enough to take full advantage of that match. Now, if you're self-employed, you could also use a Roth IRA account. This is for you when you deposit after taxed income to make tax-free investments until you retire. You won't need to pay any taxes when you withdraw those in retirement. Let's say you're earning a 10% return annually. If you're investing in a taxable account, some of those returns will get eaten away by capital gains taxes. But in a tax advantage account, your money grows without getting eaten away by taxes, letting compounding work more efficiently for you. Unless you want to withdraw your investments in the short term, use these tax advantage accounts to retain your capital gains as much as you can to help reach your 100K target faster. Step number 7, reinvest your dividends. When you buy and hold shares of ETFs like VOO or QQQ or some individual companies, you will receive a dividend payment several times a year. This is your third income stream on top of the interest from your high yield savings account and your capital gains. Instead of cashing out those dividends that you receive, reinvest them so you can further speed up your wealth compounding. When you reinvest your dividends, you're using those monies to buy back the shares of the same stock or ETFs that you got it from. And those extra shares will earn you more dividends down the line as well too. Most brokerages makes this super easy with something called a dividend reinvestment plan, or DRIP for short. It's automatic, so you don't have to do anything once you set it up. Make sure to look into the settings of your investing app and enable this option. The first 100K is difficult, so every effort counts. These 7 steps are the most essential actions that you can take to create these 3 streams of income that you don't have to sit on like a full-time job. I have a more detailed PDF guide for you to quick start your investing journey. You could receive a free copy by joining my free weekly newsletter where I share investing ideas and market updates and exclusive deals in my newsletter for completely free. This quick start investing PDF guide will be emailed to you as soon as you sign up. In case you didn't receive it, make sure to check your promotions or spam box. If you're ready for more in-depth investing concepts, click this video to learn the 3 investment strategies that you must know, and I'll see you in the next video.